I'm Arlen Myers. I'm President and CEO of the Society of Physician Entrepreneurs, and thanks for joining us. I'm also an advisor to ABAIM, so I'm sure you're familiar with that organization. Hi, Bill.
Hey, good morning. How is everybody doing? My apologies.
Great, good. No problem. Thanks. Yeah, thanks for joining us. So,
absolutely.
So just to get started and get to the nitty gritty, Bill, why don't you just briefly introduce yourself to the audience?
So thanks, Alan. I appreciate that. So my name is Bill Sobers. I'm a Vice President at Wealth Management at UBS Financial Services and working in Phoenix, Arizona. I have with me today one of our analysts, Eric Podaker, who is going to talk a little bit more about what we see with the healthcare industry and just answer some questions about different investment vehicles and how that would impact the healthcare industry. So with that, I can turn it over to, is Eric on? I don't see him on there. Is he?
Yeah, Eric's
I'm on.
Okay.
He's on the phone.
Yeah. Oh, very good. Okay, very good. So I thought,
he had a glitch. He had a glitch with his microphone or something. But anyway, we're fortunate we got him. So
yes.
Okay, Eric, do you want to introduce yourself?
Yeah, sure. My name is Eric Podaker. I am the healthcare equity strategist at UBS within the Wealth Management Group, and I've covered healthcare equities for the last 2 decades at a couple of different equity long-short funds, and I also ran a healthcare portfolio at a family office. And I look at healthcare from a public market perspective, and I've covered the sector broadly: pharma, biotech, medical devices, and healthcare services. Earlier in my career, I worked as an investment banker where I did do a lot of work with smaller to mid-sized physician groups that at the time were looking to capitalize and monetize their physician practices. So a little different than the focuses that I've heard on this call from the physician entrepreneurs, but it gave me some insight to actually what's again occurring now 20 plus years later in terms of what some physician groups are trying to do. But with that, I'm happy to give you sort of just overview of the healthcare equity sector from a public market standpoint, and then we can get into some of the more specific questions, I think, Arlen, that you teed up. But from a public market perspective, the healthcare sector is really dominated by the large capitalization, large companies in terms of market cap. Pfizer, Johnson & Johnson, Medtronic. But there's really quite a bifurcation in how the equity markets look at healthcare stocks. The large cap companies tend to be valued quite low relative to where they've been valued historically, and there's a couple of reasons for that. The main reason is they're just not perceived as reliable long-term growth companies, and there are a number of structural issues behind that. And then the other secondary issue is concern, particularly over the last 5 years, about drug pricing. Again, the healthcare sector is still dominated by pharma companies, and the concern about drug pricing in the U.S. really started in 2015, and there's really been quite a downward pressure on the valuations for those companies. Now, I mentioned that it's a bifurcated market. On the other side, you see this tremendous excitement for smaller capitalization companies, mostly biotechs, but also particularly in the last year, digital healthcare companies, telehealth companies. COVID-19 has really accelerated both the business models for a lot of those companies, but also the investor appetite for those, what I would call healthcare services / data companies that are quite different in their business models from the biotech. But biotechs are still driving most of the small and mid capitalization excitement in the marketplace. And it's simply because they have the ability to grow at tremendous speeds from having 0 revenues prior to having a drug approved to potentially having hundreds of millions, if not in the billions of dollars very quickly. So these are very scalable business models that investors just really value the growth that these companies can quickly provide. And as I said, very scalable companies, they arrive at, once they have products on the market, the gross profits are large, the operating leverage, i.e. the profits that they can return to shareholders are large, and they're very visible exits for the investors in these companies via M&A mostly, as those larger cap companies I mentioned before need to fuel what growth they can get by acquiring some of these smaller growing companies. So that created a bifurcation in how the equity markets look at healthcare, where the large companies are really viewed as growth challenged, and the overall equity market is still driven by a preference for growth over value. And that theme pervades healthcare, but also pervades other sectors as well, particularly technology. So with that preference for smaller cap growth companies, you see that filtered down now, obviously, into the pre-public space, particularly venture capitalists and the sort of surge in venture capital that's taken place over the last decade. The number of venture capital financings and the number of IPOs in the healthcare sector have gone up by multiples within the last decade. And just to give some context for the performance that I mentioned, the bifurcation in public markets, widely traded exchange-traded fund called the XBI, and that's a group of small and mid-sized publicly traded biotechnology companies, roughly 100 companies at any one time, and that ETF, that exchange-traded fund, is up 350% over the last 5 years. So 75% compounded annual return for investors who have invested in a liquid exchange-traded fund that captures a lot of that growth and excitement and flow of funds that's gone into the biotech space. And that just doesn't compare to anything else in healthcare. So you can see why there's that preference, and that preference for growth and small cap companies just filters down through the various stages of private company investing. And we're seeing it this year, both in the growth and IPOs, which continue at a record pace, but also in the more recent emergence of what are known as special purpose acquisition companies, or SPACs, that have created an alternative way for private companies to get public. And that SPACs have been around for decades, but the recent upsurge in SPAC activity is just another dynamic in sort of the excitement of capital markets to fund growing healthcare companies. Probably best for me to stop there and just take any questions.
Great.
Either
Yeah.
from
So
you
one
all or from the
question.
audience.
You mentioned biopharma. You mentioned digital health. What about med tech, and what about sort of platform or tools company and care delivery?
Yeah, so life sciences tools has actually done quite well, because those companies have been able to position themselves as solid growth companies. And you can go from very large capitalization companies like Thermo Fisher or Danaher to smaller ones. And they've been able to do that pharma doesn't have, is they've been able to show long-term sustainable growth. The issue with pharma and large biotech is that they can build billion-dollar revenue franchises, but eventually their exclusivities lapse because their patents go away, and there's a ready-made industry to then take market share at significantly discounted prices via the generic drug companies. Life science tools companies don't have that issue. They are selling literally thousands of different products through very strong distribution channels, and they're benefiting from the innovation in biotechnology and in molecular science, because they're providing all the tools that are used to do that research. So that's been an attractive area of sort of large cap and small cap growth. And then for medical devices, the large cap companies have done quite well because over the last 5 years, in part because pharma has suffered, and in part because there is not a similar pricing concern with the large cap medical device companies. They dealt with pricing pressures from their customers over a decade ago, but their business models have adapted to the point where they really don't depend on price. They depend on volume and innovation in terms of driving new and adjacent markets. And given the demographics and the ability to continually innovate on surgical procedures, continually incorporate things like robotics, they're getting more growth. So those companies have actually been valued, again, mid-cap companies, small cap companies valued at quite high multiples. Large cap, certainly much better than pharma. And a lot of those companies have benefited this year from being able to deliver COVID-19 tests. There's a number of medical device companies and life sciences tools companies that have seen massive growth this year from new testing demand. The debate in the market is how long will that growth persist? How quickly will it fall off? That's a separate discussion, which if anyone wants to, I'm happy to go into. But suffice it to say, there's enough perceived growth in those sectors that they've done quite well, and that then filters through from large cap to mid cap to small cap and into the private markets.
And what about specifically AI, since this is an AI platform?
Yeah, and I'll confess, I don't have the same insights into the AI market because it's smaller, and most of my coverage universe are larger companies. But anecdotally, I know that there is significantly more venture capital going into AI. I think in the fourth quarter, I saw a statistic that there was about $2.3 billion in U.S. AI investments by venture capitalists. Interestingly, those tended to be larger investments in fewer companies than what the trend had been leading into the fourth quarter. But regardless, it's a robust amount of money going into AI in the private sector. We haven't yet seen, at least I haven't, I can't point to in the public markets, large pure play stocks that have sort of galvanized investor interest yet, other than to the extent one could say robotics and robotic surgery is to some extent an AI play. I don't know that there's unanimity in that characterization, but it's certainly from a public and market investor standpoint, it's easy to draw that connection and think about how strongly robotic surgery has grown, how many large companies are now pursuing it, and how that could be tied into an AI theme and sort of whet the appetite from public investors for more AI investment. But it's clearly taking place in the private equity markets with venture capitalists, just given the amount of money being put into AI deals.